You know, we all love seeing progress, a brand new bridge, a super fast highway. But what if those massive projects we see, what if they come with a hidden financial catch, a price tag that you won't find on the official sticker? That's exactly what we're going to dig into.
So let me ask you this. Picture that new toll road you're driving on. What if the government secretly promised the private company that built it that they'd make a certain amount of money no matter what? Even if, hardly anyone actually drives on it. That's the crazy idea we're exploring today.
And this promise, it actually has a name. It's called a minimum revenue guarantee, or MRG for short. And it is exactly what it sounds like. The government promises a private company a minimum level of income for taking on a big public project. It's basically an insurance policy for the company against low traffic. All right, so you're probably thinking, why on earth would a government make a promise like this? It sounds, well, pretty risky, right? But the thing is, it's often the key that unlocks the private money needed for these huge, complex projects, the kind of projects most investors would normally run away from.
Look at it from the investor's side. Building a multi-billion-dollar bridge is a massive gamble. What if the traffic forecasts are wrong? What if the economy tanks? Well, an MRG takes a huge piece of that risk right off the table. It literally puts a financial safety net under their investment, which makes them way more willing to get on board.
Right, but here's the catch. That risk, it doesn't just disappear. It has to go somewhere. It gets transferred. So the big question becomes, if the company isn't on the hook when things go wrong, who is?
And this is where you can really see that shift happen. All those normal business risks, not enough cars, a bad economy, things that would typically be the company's problem, they get handed right over to the government. And when we say government, what we really mean is taxpayers. The risk lands right on the public's shoulders.
So how does it actually get triggered? Well, if the money coming in from the project drops below a certain level, usually somewhere between 70 and 90% of what they thought it would be, then boom, the government has to cut a check for the difference. And this isn't just a one-time bailout. This promise can lock a government in for the entire life of the project. We're talking 20, sometimes 30 years.
And this is where things get, well, a little messy. This whole structure, it kind of creates this dangerous incentive trap. There's a fundamental flaw baked right into the system, and it can lead to some really bad outcomes.
So problem number one is something experts call optimism bias. Think about it. If you're a company bidding for a project and you know a higher revenue forecast means you get a higher government guarantee, well, there's a pretty big incentive to be, let's just say, very optimistic about how much money that project is going to make. And this quote just nails it. When everyone is encouraged to shoot for the moon with their predictions, the guarantee gets set at a level that's just not realistic. This makes it way more likely that the government is going to have to pay up, and those payments can end up being way bigger than anyone planned for.
And that brings us to problem number 2. It's this classic idea that economists call moral hazard. Let me ask you this. If you knew there was a safety net that would catch you every single time you fell, would you be quite as careful about keeping your balance?
Exactly. Why would a company spend extra money on marketing or on improving this service to get more customers if they know the government's just going to cover their losses anyway? That normal commercial pressure to succeed, it gets a lot weaker. And that can mean the project isn't as good as it could have been for everyone.
So we've got these hidden, long-term promises just lurking in the background. What happens when the bill finally comes due? This is where that financial risk stops being a number on a spreadsheet and starts having a real impact on public services we all rely on. It's really like an iceberg, isn't it? What we all see, above the water, is the shiny new project. But what's hidden deep below the surface are these massive off-the-books promises. They don't show up in the budget year after year, until all of a sudden they're triggered. And that creates these sudden, unpredictable demands for cash that can threaten everything else.
And that's the real gut punch here. When a government suddenly has to write a huge, unplanned check for a toll road that isn't making enough money, that cash has to come from somewhere. And too often, it gets pulled from the budgets for schools, for hospitals, for other critical public services. That is the real price of these hidden promises.
And if that wasn't bad enough, here's the final twist of the knife. These guarantee payments are most likely to kick in during an economic downturn. That's exactly when people are using things like toll roads less, and it's also when the government's tax revenues are already shrinking. It's a risk that hits you when you're already down, putting the absolute most pressure on public finances at the worst possible time.
Okay, so
After all that, things might seem a little bleak. But it's not a lost cause. The answer isn't to just stop building big things. It's about managing this risk a whole lot smarter. So, how can we do this better? Let's take a look.
There's actually a pretty clear playbook for how to do this right. It starts with doing your homework, really stress testing those financial models for the absolute worst-case scenarios. It means setting hard limits on how much total risk a government is willing to take on across all of its projects. And, maybe most importantly, it means being transparent about it. Report these hidden obligations so that everybody knows what's really at stake.
And there are just much smarter ways to set up these deals. You have things like revenue collars, where both sides share the pain when revenues are low, but they also share the rewards when they're high. Or availability payments, which totally flip the script. The government just pays a flat fee for the road to be open and well-maintained, taking that whole risky guessing game about traffic completely off the table. And finally, you can just tie payments to how well the service is actually run. All of these create a real partnership, not just a one-sided safety net. So, when you boil it all down, these guarantees can be a powerful tool. They can get big things built, but they come with some deep, hidden risks. They can turn a company's business risk into a taxpayer's problem. They create some really warped incentives, and they can drain public money at the worst possible times. Which leaves us with one final thought. The next time you see a grand new public project being announced, will you be the one to ask about its hidden price tag?